What if I told you that Zebec ZBCN has a built-in deflationary mechanism that most holders don't even understand, and that an aggressive supply burn could send this token into price discovery mode that would shock the entire crypto market? Welcome to Crypto Journal. Hit that like button if you value this type of tokenomics deep dive and want me to keep bringing you these analytical breakdowns. And don't forget to join the channel membership, where I'll be uploading exclusive content just for members. You'll see the join button right next to subscribe. After what I'm about to reveal about ZBCN's burn mechanics, you'll understand why being in the inner circle gives you the edge. We're in November 2025, and ZBCN currently has 93.76 billion tokens in circulation out of a maximum supply of 100 billion. But here's what nobody's talking about. Zebec already has multiple burn mechanisms actively reducing supply. And if they accelerate these mechanisms or implement additional burns, the price impact could be massive. Stick around, because at the 17-minute mark, I'm going to show you the exact mathematical models of how different burn scenarios would affect ZBCN's price based on current market dynamics. Let me start by explaining ZBCN's current deflationary tokenomics, because understanding the existing burn mechanics is critical before we analyze potential future burns. ZBCN has what they call a fee structure of 1 ZBCN per transaction. Every single transaction on Zebec Network costs exactly 1 ZBCN token as a gas fee. This isn't just paid to validators. A portion of that fee is automatically burned, permanently removed from circulation. Think about the implications. Every bridge transaction into Zebec Network burns ZBCN. Every payment stream burns ZBCN. Every treasury operation burns ZBCN. The more the network is used, the more tokens are permanently destroyed. This is deflationary by design. Unlike inflationary tokens, where supply constantly increases, ZBCN's supply constantly decreases with usage. But here's where it gets really interesting. The burn rate is directly tied to network activity. As Zebec scales, as institutional adoption increases, as payment volume grows, the burn rate accelerates proportionally. We're not talking about speculative burns. We're talking about organic, usage-driven deflation that compounds over time. In November 2024, Zebec announced a buyback and burn program specifically tied to their card products. This is a massive development that flew completely under the radar. The program has 2 components. First, partner contributions. When projects pay Zebec with their tokens to integrate with Zebec cards, Zebec buys an equivalent amount of ZBCN from the open market and burns it. Second, card volume burns. As Zebec card programs grow, they burn an amount of ZBCN equivalent to the monthly total spend volume on Zebec cards, up to a limit of $500,000 per month. Let me repeat that. Up to $500,000 worth of ZBCN burned every single month just from card spending volume. At current prices around $0.0036, $500,000 represents approximately 138 million ZBCN tokens burned per month. That's 1.66 billion tokens per year at maximum card volume. From a current circulating supply of 93.76 billion, that's 1.77% annual deflation just from the card burn mechanism alone. And that doesn't include transaction fee burns or future buyback mechanisms. Zebec stated they would provide a public dashboard tracking all buyback events in real time. This creates transparency and accountability. Holders can literally watch supply decrease month by month. Now let me explain why Zebec implemented this buyback program, because the reasoning reveals their long-term strategy. Zebec operates as a multi-chain ecosystem, but they rely heavily on Solana for transaction processing. Cards, rewards distribution, and essential operations run on Solana. Here's the problem. Solana uses SWL for gas fees, not ZBCN. So while Zebec's card products are generating massive transaction volume, That volume doesn't directly create ZBCN demand for gas. To address this and reinforce ZBCN's value as a deflationary asset, they reinstated the buyback program to reduce circulating supply and increase scarcity. This is strategic tokenomics. They're manually creating the deflationary pressure that would naturally occur if all transactions happened on Zebec's native chain. And as Zebec transitions more activity to their Nautilus chain, a layer 3 blockchain, where ZBCN is the native gas token, these burn mechanics will become even more powerful. Comment right now if you're starting to see how calculated this tokenomic design really is. Let me show you the current supply dynamics and unlock schedule, because understanding what's coming is critical for analyzing burn impact. ZBCN has a maximum supply of 100 billion tokens. Current circulating supply is 93.76 billion. That means 6.24 billion tokens are still locked or unvested. According to CryptoRank data, there's a significant unlock event scheduled for March 16, 2026. Approximately 283.7 billion tokens will unlock. Wait, that doesn't make sense with the max supply. Let me clarify. This is likely referring to the old ZBC token supply before the 1-to-10 split. After the migration from ZBC to ZBCN in April 2024, each old ZBC became 10 new ZBCN. So the unlock schedule adjusted proportionally. The key point is there are still vesting schedules for contributors, private round investors, and seed round investors. These follow a 6-month lockup followed by linear vesting over 3 years. Public sale tokens were fully unlocked at distribution. Market-making tokens vest gradually over 36 months. This creates a steady supply increase over time, which is exactly why burn mechanisms are critical. Without burns, the circulating supply would increase from 93.76 billion toward the 100 billion max supply. With burns, circulating supply could actually decrease even as tokens unlock. The net supply becomes a function of unlock rate minus burn rate. And if burn rate exceeds unlock rate, you get net deflation even during vesting periods. That's when price action gets really interesting. Now let me walk you through scenario analysis of how different burn rates would impact ZBCN price, because this is where we get into the real mathematical implications. Let's establish current baseline metrics. Circulating supply is 93.76 billion ZBCN. Current price is approximately $0.0036. That gives us a market cap of approximately $337 million. Scenario 1, current burn rate maintenance. If Zebec maintains current burn mechanisms without acceleration, we're looking at approximately 1.5 to 2% annual deflation from transaction fees and card burns combined. Over 5 years, that would reduce supply by 7.5 to 10%. Circulating supply would drop from 93.76 billion to approximately 84 to 86 billion. If demand remains constant and supply decreases 10%, basic economics suggest price should increase approximately 11% to maintain market cap equilibrium. But that's conservative because it assumes zero demand growth. In reality, if Zebec's partnerships with Ripple, institutional adoption, and RWA integration accelerate, demand increases while supply decreases. That's when you get exponential price action. Scenario 2, moderate burn acceleration. Let's say Zebec increases buyback limits from $500,000 to $1 million per month. And let's say network activity doubles, doubling transaction fee burns. Now we're looking at approximately 4 to 5% annual deflation. Over 5 years, that's 20 to 25% supply reduction. Circulating supply drops from 93.76 billion to 70 to 75 billion. With constant demand, that's a 26 to 33% price increase just from supply shock. But again, this assumes zero demand growth. If institutional adoption is happening simultaneously, You layer demand increase on top of supply decrease. Price doesn't move linearly, it moves exponentially. Scenario 3, aggressive burn program. This is the scenario that gets really interesting. What if Zebec implements a one-time burn of unvested tokens? Or what if they burn treasury reserves? Or implement a governance proposal for a major supply reduction? Let's model a hypothetical 20% supply burn. Circulating supply drops from 93.76 billion to 75 billion. If market cap remains constant at $337 million, price per token increases from $0.0036 to approximately $0.0045. That's a 25% price increase from pure supply shock. But here's where it compounds. A major burn announcement creates FOMO. Retail investors see scarcity increasing. Institutional investors recognize improved tokenomics. Trading volume surges. Market cap doesn't stay constant. It increases. If the burn triggers a market cap increase to $500 million, common in bull markets after major positive developments, price goes to approximately $0.0067. That's an 86% increase from current levels. And if the burn happens during a broader crypto bull market, when risk appetite is high and capital is flowing into altcoins, the multiple expands even further. We could see ZBCN reach $0.01 or higher, representing a 178% gain from current prices. This isn't speculation. This is mathematical modeling of supply-demand dynamics. Now let me show you real-world examples of how token burns have impacted other cryptocurrencies, because historical precedent matters. Binance Coin, BNB, implements quarterly burns based on trading volume. Since launching their burn program, BNB has burned over 55 million tokens, reducing supply from 200 million to approximately 144 million. During this period, BNB price increased from under $10 to an all-time high over $690. Obviously, burn wasn't the only factor. Exchange growth, ecosystem expansion, and bull markets contributed. But the burn mechanism created sustained deflationary pressure that supported price appreciation throughout multiple market cycles. Ethereum implemented EIP 1559 in August 2021, introducing a burn mechanism for base transaction fees. Since implementation, over 4 million ETH have been burned, worth approximately $8 billion at peak prices. Ethereum went from inflationary to deflationary during high network usage periods. Post-EIP 1559, ETH significantly outperformed Bitcoin during the 2021 bull run. The burn narrative became a major talking point for institutional investors. Scarcity plus utility equals value. Shiba Inu, SHIB, implements community-driven burns. While SHIBS burns are a tiny percentage of massive supply, each burn announcement creates short-term price pumps. The community rallies around burn events, creating social momentum that drives buying pressure. Terra Classic, LUNC, implemented aggressive burns after the Terra ecosystem collapse. Despite catastrophic damage to the project, burn announcements consistently created 20 to 50% price rallies as holders anticipated supply reduction. The pattern is clear. Burn announcements create immediate market reactions. Sustained burn programs create long-term deflationary pressure. When burns are tied to real utility and ecosystem growth, not just artificial scarcity, the impact compounds. ZBCN has the advantage of burns tied to real usage. Card spending, transaction fees, institutional payment flows. This isn't Shiba Inu burning for marketing. This is deflationary economics driven by fundamental adoption. Let me explain the psychological and market mechanics of why burns create price impact, because understanding investor behavior is crucial. Burns create scarcity narrative. Humans are hardwired to value scarce resources. When investors see supply decreasing, they perceive increasing rarity. This triggers fear of missing out. If I don't buy now, there will be less available later. Burns signal confidence from the project team. When a team burns tokens, especially from treasury reserves, it signals they believe in long-term value creation over short-term liquidity needs. It shows commitment to holders. This builds trust and attracts long-term investors. Burns improve holder psychology. When holders see their token supply becoming more scarce, they're less likely to sell. Why would you sell an asset that's becoming rarer? This reduces sell pressure naturally. Lower sell pressure means less downward price action. Price stabilizes or trends upward. Burns create media and social narratives. Every burn announcement generates content. YouTube videos, Twitter threads, Reddit discussions. This organic marketing drives attention to the token. Attention drives discovery. Discovery drives new buyers. New buyers drive price. And critically, Burns improve tokenomics metrics that institutional investors analyze. Institutions don't just buy narratives. They analyze supply dynamics, inflation rates, terminal value. A deflationary token with growing utility scores higher in quantitative models. This attracts algorithmic trading strategies and institutional capital allocation. ZBCN benefits from all these psychological factors. They just need to communicate burn data more aggressively to retail investors. Now let me talk about potential burn mechanisms that Zebec could implement beyond current programs, because there are multiple strategic options. First, governance-directed treasury burn. Zebec holds tokens in treasury for ecosystem development, partnerships, and operational reserves. The community could propose burning a percentage of these reserves. If governance votes to burn 10% of treasury holdings, and assuming treasury holds approximately 3 to 5 billion ZBCN, that's 300 to 500 million tokens permanently removed. That's a 0.3 to 0.5% supply reduction from a single governance action. Second, revenue-based continuous burns. Zebec generates revenue from card fees, off-ramp services, and institutional partnerships. They could commit to using 10 to 20% of monthly revenue to buy and burn ZBCN from open markets. As revenue scales with institutional adoption, burn amounts scale proportionally. This creates a direct link between business success and token value. It's the ultimate alignment of incentives. Third, staking burn mechanisms. Zebec could implement staking where a small percentage of staking rewards come from newly minted tokens, but an equal or larger percentage of transaction fees are burned. This keeps net inflation negative while rewarding long-term holders. Staking locks supply out of circulation. Burns reduce total supply. Combined effect is massive reduction in liquid circulating supply available for trading. Lower float with constant or increasing demand equals significant price appreciation. Fourth, milestone-based burns. Zebec could announce burns tied to adoption milestones. When they hit $1 billion in payment volume, burn 1 billion tokens. When they onboard 100 institutional clients, burn 500 million tokens. This gamifies adoption for the community. Holders become evangelists because they know growth triggers supply reduction, and it creates anticipation. Markets price in future burns before they happen. Fifth, deflationary NFT mechanisms. If Zebec launches NFT collections tied to premium features or governance rights, they could require burning ZBCN to mint NFTs. Every NFT minted permanently removes tokens from circulation while creating a new asset class within the ecosystem. Any or all of these mechanisms could be implemented through governance proposals. And that's the beauty of decentralized networks. The community controls tokenomics evolution. If you're still watching, comment burn mechanism now. I want to see who understands the power of deflationary tokenomics. Let me compare ZBCN's tokenomics to competing payment infrastructure tokens because relative value matters. Chainlink, LINK, has a maximum supply of 1 billion tokens with approximately 583 million circulating. LINK is inflationary with staking rewards increasing supply. Market cap is approximately $11 billion. Price is approximately $19 per token. Chainlink provides Oracle infrastructure. Zebec provides payment infrastructure. Both are critical infrastructure layers. But Zebec has deflationary tokenomics while Chainlink is inflationary. If Zebec captures even 10% of Chainlink's market cap, that's $1.1 billion market cap. At current circulating supply of 93.76 billion ZBCN, that's a price of approximately $0.012. That's a 233% increase from current prices. And with burn mechanisms reducing supply, the math gets even more favorable. If circulating supply drops to 75 billion through aggressive burns, that same 1.1 billion market cap equals a price of $0.015. 317% increase. The graph, GRT, has a maximum supply of approximately 10.7 billion tokens with 9.5 billion circulating. Current market cap approximately $1.8 billion. Price approximately $0.19. The graph is inflationary with indexing rewards. If ZBCN reaches the graph's market cap of $1.8 billion with current supply, price goes to $0.019 for 128% gain. With reduced supply from burns, even higher. Render, RNDR, has a circulating supply of approximately 538 million tokens. Market cap approximately $4 billion. Price approximately $7.5. Render has burn mechanisms tied to GPU rendering usage. Render shows what's possible when you combine real utility with deflationary tokenomics and a smaller supply. ZBCN has 100 times the token supply, but if it reaches even 1/10 of Render's market cap with aggressive supply reduction, the percentage gains are massive. The takeaway? ZBCN is undervalued relative to competing infrastructure tokens. And burn mechanisms amplify the upside by improving the supply side of the equation. Now let me address the risks and counterarguments, because I don't do one-sided analysis. First, burns don't guarantee price increases. If there's no demand for the token, reducing supply alone won't create sustained value. Zebec needs to continue delivering on partnerships, institutional adoption, and real payment volume. If the Ripple integration doesn't materialize, if RWA adoption stalls, if competition from other payment protocols intensifies, ZBCN could underperform even with burns. Burns are a multiplier on demand, not a replacement for it. Second, aggressive burns reduce treasury flexibility. If Zebec burns too much too fast, they might not have sufficient tokens for future partnerships, ecosystem incentives, or development funding. There's a balance between creating scarcity and maintaining operational capability. Third, unlock schedule creates ongoing sell pressure. Even with burns, the vesting schedule means new tokens enter circulation regularly. Contributors and early investors will eventually sell. If unlock rate exceeds burn rate, net supply still increases. Fourth, market cap growth requires capital inflows. For ZBCN to appreciate significantly, new capital needs to enter. That requires either retail FOMO, institutional adoption, or both. Burns create the narrative, but capital inflows create the price action. And fifth, regulatory risk. Zebec operates in payments and financial infrastructure. Increased regulatory scrutiny on crypto payments, stablecoins, or cross-border transactions could impact adoption regardless of tokenomics. My take: the burn mechanisms are powerful, but they're not a magic bullet. ZBCN needs to execute on institutional partnerships and deliver real payment volume. If they do that, burns amplify the upside dramatically. If they don't, burns alone won't save the token. Let me bring this all together with my assessment of how aggressive burns would realistically impact ZBCN. The fundamental thesis is that ZBCN is building real institutional payment infrastructure. Partnerships with Ripple, integration with Arcax for BlackRock and Fidelity funds, deployment of payment cards in over 100 countries. This is real utility, real transaction volume, real institutional interest. The tokenomics layer built on top of this utility is already deflationary. Transaction fees burn ZBCN. Card spending burns ZBCN. Buyback programs remove supply. If Zebec accelerates burns through governance proposals, milestone-based programs, or increased buyback allocations, the supply side improves dramatically. Combine reducing supply with increasing demand from institutional adoption, and the price dynamic becomes extremely favorable. Conservative scenario: moderate burn acceleration with steady institutional growth. ZBCN reaches $0.008 to $0.01 in 12 to 18 months. That's 120 to 178% upside from current levels. Base case scenario: aggressive burn program announced combined with major partnership developments like formal Ripple integration or additional institutional asset tokenization. ZBCN reaches $0.015 to $0.025. That's 317 to 594% upside. Bull case scenario: multiple burn mechanisms implemented. Institutional adoption accelerates faster than expected. Crypto market enters sustained bull phase. ZBCN reaches $0.05 to $0.1. That's 1,289 to 2,678% upside. These aren't Moonboy predictions. These are mathematical outcomes if certain conditions are met. Supply reduction plus demand growth equals exponential price appreciation. It's Economics 101. The key catalyst to watch is governance proposals around burn mechanisms. If the community starts voting on aggressive supply reduction, that's your signal that holders understand the tokenomics playbook. And if Zebec leadership starts communicating burn data more prominently, marketing the deflationary narrative, retail awareness increases. Wall Street loves buybacks. They're proven to boost stock prices. Crypto burns are the equivalent mechanism, and institutional investors moving into crypto bring that Wall Street mindset with them. They'll recognize ZBCN's burn mechanics as favorable tokenomics. This is Crypto Journal, and I want to leave you with this. Tokenomics matter. Supply dynamics matter. A great project with inflationary tokenomics will underperform a good project with deflationary tokenomics over long time frames. ZBCN has both. Real utility building real infrastructure for institutional payments, and deflationary mechanics that reduce supply as usage increases. If they execute and communicate effectively, this is one of the most asymmetric opportunities in mid-cap infrastructure tokens. If you found value in this tokenomics deep dive, smash that like button. This type of analysis takes hours of research and mathematical modeling. Engagement helps me reach more people who need this level of detail. Join the channel membership for exclusive content where I'll be tracking ZBCN's burn data, governance proposals, and supply dynamics in real time. The join button is right there next to subscribe. After understanding the burn mechanics, you know why tracking this data gives you an edge. Drop a comment telling me, do you think Zebec should implement more aggressive burn mechanisms? Or should they prioritize treasury reserves for partnerships and development? I read every comment, and your perspective shapes my analysis. Subscribe if you haven't already, because as ZBCN's burn programs evolve and institutional adoption progresses, I'll be covering every development that impacts supply dynamics and price potential. The biggest opportunities in crypto aren't always the highest priced tokens. Sometimes they're the tokens with the best supply-demand dynamics that nobody's paying attention to yet. ZBCN is building deflationary infrastructure in plain sight. Now you know what to watch for. See you in the next one.